Welcome back to The Exchange. We'll get a check on the state of spending with today's earnings exchange because we've got the action, the story, and the trade on Pepsi, Delta, and Conagra, all getting set to report. Our trader today, Jeff Kilberg, KKM Financial CEO and a CNBC contributor. It's great to see you, Jeff, and I'm very excited to dive into Pepsi. It's down 6 of the last 7 weeks as concerns about the strength of snacks continue. Jefferies sees increased promotions, softer Frito volumes. We've talked with analysts on this program about these concerns. We've done a deep dive into whether they have to keep cutting price to bring shoppers back. And after what happened with Helen of Troy and already with some of these other names, I'm a little worried about this one. What would you do with the stock here?
Well, I think that anxiety provides opportunity, Kelly. So I want to be a buyer here. And yes, you're right. Down 4% year to date over the last year, down a little over 10%. And this has been a consumer staple. Consumer staples, by and large, have been ignored by investors. And God forbid we actually see the Mag 7 run out of gas. You could see a consumer staple like Pepsi come back in vogue. If you look at a forward PE, it's historically trading pretty cheap. It's trading at a forward PE of about 20. On the last 5 years, the average has been about 24. So I think there's an opportunity here, and I actually utilize the options market to express what's going to happen before the bell because those earnings are coming out tomorrow morning.
All right, I'm watching the aisle to see if there's more discounts on, what is it, Fritos and Ruffles and all of their.
You like Frito?
Yeah. And all of their products. It's going to be a bellwether, I think. If Pepsi doesn't do well, I think they're going to take the whole, more so than they have, I think they're going to take the sector to the woodshed. Okay.
You're absolutely right. And I think that's why you think of these three names. I know they're not the trillion-dollar market cap stocks that we like to talk about all the time, but these three names we're discussing today, they are bellwethers. They are important. This is what the Midwest here in Chicago, this is what's important to the U.S. economy. So I think it's critical to look at these names, even if you're not trading them.
And people are trying to go through and say, okay, the consumer's getting choosier, so we've got to find out what are they choosing, what are they not, which is a good segue to Conagra. Slim Jim, Ready Whip. Sometimes people perceive it as to have slightly a weaker portfolio maybe than some of the other consumer products companies, but it's also usually priced accordingly. It's already down 7 of the past 8 weeks, too. So is private label going to entrench with grocery volumes declining? Would you be a buyer of this one?
I would not be a buyer here. And I just think the simple reason, Kelly, look at the last 5 years. This stock has gone nowhere. You've been better off owning a U.S. government bond. And I think at this moment in time, if you do see a tilt back into consumer staples, I don't know. They got excited about canned meat. I don't know if I get too excited about canned meat. So from a Conagra perspective, I think if you have it, you can hold. But look at a chart. If you look at a chart, that 50-day moving average is up at 29.66. That should provide some short-term resistance, but I don't want to own this name. I want to put my money elsewhere from a consumer staple perspective because Conagra has just been plain out and flat out sitting in a can just like their canned meat.
Yeah, it reminds me, too. It's sort of like either they're, darned because they're a Helen of Troy, or they could be a breakout candidate like a Walmart where it's kind of for the wrong reason. Like Walmart Recession Indicator, I wrote about, Jim Paulson covered this. When that breaks out compared with the luxury sector, it's usually been a bad sign. Anyway.
And that's a great point. That's a great point. I think you use 29 or 30, use that $30 level. If it does vault above there, then you could be a buyer, but I want to stay away from it.
All right, let's move on to Delta then, which is somewhat related, somewhat not. And it's down 7% in the past month after those guidance cuts from American and Southwest. B of A, though, says corporate and international exposure should help to insulate this stock. It's you always usually want to own the best performer in any industry, although this is a tough industry to own, as has long been discussed. Would you buy Delta here?
I own Delta, so yes, I'd be buying and adding to it here. When you think about United and American combined, those two market caps are still less. So this is the big boy. And I like owning the biggest name here. I think you're right. You noted earlier in the show when you talked about the record travel. We just saw on Sunday over 3 million people check through TSA. So that record travel is still occurring. We've seen so many records this year. We're seeing business travel back on the up. And their plan a long time ago, Kelly, Delta talked about how they can essentially ding the business traveler for that premium upcharge, just sit in the front of the bus, if you will. And I think that's finally paying off. So I like being positioned in Delta. If you don't necessarily like the airlines, I understand that. But this is the one name that we actually own in our Essential 40 portfolio because we think it's the best of the airlines.
Amazing. Outperforming American by 30 points this year.